Ladies and gentlemen, it's a great honor to be asked to address this conference, and I'm very grateful to LARIBA, American Finance House, and its associates for inviting me to attend. I am a bank analyst with Moody's Investor Service based in London, and so my perspective for you today is that of someone who has spent most of his career analyzing financial institutions in the Middle East, and more recently has shifted his focus to financial institutions in Western Europe. The presentation which I gave to the organizers of the conference is far too long to give to you now. So yesterday I judiciously cut it down to about 15 minutes, and I guess I'm going to have to judiciously cut it down a little bit more to about 10 or so. So I'll see what I can do. And so what I'm going to do is to ad lib a little bit and try to draw out the main themes of my presentation. The banking industry is undergoing steady and profound change throughout the world. The areas in which banks have traditionally made their money are being reduced, eliminated by technology, or taken away from them by new players in the market. And so to compensate, banks are pursuing new areas of growth, such as asset management and insurance. If you look at the balance sheet of a bank today, it looks very different from the balance sheet of a bank 50 years ago or even 25 years ago. And if we look forward, the balance sheets of banks 25 and 50 years from now will be almost unrecognizable in relation to what we today think of as a bank. The purpose of this paper is to describe some of these long-term strategic trends facing the banking industry and to ask how well Islamic banks are placed to deal with those long-term strategic trends. In the past, I have addressed the issue of balance sheet risks for Islamic banks, and within the community, there has been a lot of analysis of, let's say, liquidity risk of Islamic banks, capitalization, asset quality. And what I want to do today is to move away from those balance sheet risks and look at the longer-term strategic risks, because I think one can say that issues such as banking technology and the changing preferences of consumers of banking products are such that these long-term strategic trends are actually of greater threat to banks than those well-rehearsed risks of asset quality and capitalization. In the time available, I'm going to look at three areas: disintermediation, technology, and balance sheet instruments. I know I said I wouldn't deal with balance sheet, but I'm going to just deal with it a little bit. What do we mean by disintermediation? Historically, banks have made their money by taking in deposits on one side and pushing out loans on the other side. The amount that you get on your deposit is less than what you pay if you take a loan, and that's how the bank makes its money. Obviously, I'm talking about riba-based banks here. And that has been a very profitable business, number one. And number two, banks have dominated financial markets. If you wanted to place a deposit, if you wanted to take a loan, where you went for it was a bank. So the banks were A, in the center of the financial system, and B, involved in very profitable business. That is changing. The most obvious example of that is the international bond market, where people who want capital now go directly to people who have capital. They don't go through the banks. But there are various other examples, particularly in retail financial services. When I do my shopping on a Saturday morning in Sainsbury's, it's a supermarket chain in the UK, when I pay for my groceries, the cashier asks me if I'd like some cash back, which I can pay for with my credit card. I'm sure you can do the same here in the US. So I don't need to go to my bank to get cash. And if I want a mortgage, I can get that from my supermarket as well. So you have a lot of new providers coming into the market who are challenging the roles of the banks. Now, you can give a lot of examples of this. The fact is that when you look at a bank's profit and loss statement, the amount of money they make from intermediating funds is going down. That is no longer such a profitable business. And so if, as a bank, that is all you can do, you will go out of business. It's as simple as that. So what you have to do is to move into areas such as asset management and insurance. Let's look at technology. Now, technology is transforming all of our lives, and we've all seen it in the banking industry as well. Let's just try to identify three specific areas of how technology is changing banking. Good heavens, only that left. Right. Increased distribution power, ATMs. It's separating manufacturing of products and the distribution of products. I'll give you an example. ING Bank, one of the biggest banks in the world, its strategy for getting into France, where it doesn't have a presence, is to use the internet only. It is not building branches. It reckons it can get to customers only by the internet, this new distribution channel. And also you can use technology to design more complex banking products. When we, as bank analysts at Moody's, look at banks and analyze banks, one of the key things we're looking at now is how sophisticated they are technologically. We didn't do that 10 years ago because it wasn't such an issue. Third issue is new financing techniques. I'm talking about securitization, structured instruments, and using things like subordinated debt. I won't go into the details, but what these financing techniques enable you to do is to get more juice out of your balance sheet. If you've got a limited amount of capital, there's only so much business that you can do unless you can increase the volume through that balance sheet. And what these financing techniques enable you to do is to increase the volume and therefore make more money. So how are Islamic banks placed in these three particular areas? Now, disintermediation is clearly a threat for Islamic banks because they take in deposits and they make credit at the other side. It doesn't matter if it's not a riba loan, they're making credit on the other side of that. But Islamic banks are very well aware of the opportunities for asset management. Now, I hesitate to use the word mudaraba after Mahmoud al-Jamal's presentation this morning, but the fact is that Islamic banks are well used to offering investment funds. And in fact, I think one of the most exciting things that's happening in the Islamic finance market at the moment is the spread of investment funds as opposed to pure banking. So it would seem that Islamic banks, while they're at they face the threat of disintermediation on their balance sheet, are already looking at opportunities for fee income from asset management, which is a very positive point. If we look at technology, we've seen that technology is sometimes opposed in its early stages in the Muslim world. If you can see examples of Saudi Arabia, see examples of Saudi Arabia when the telegraph was introduced at the beginning of this century, or perhaps television even in the 1960s, there was some opposition. But the fact is that over time, technology has made its way into the Islamic world pretty much in the same way as in the Western world, with one qualification, which is the use of the internet in some states where the governments are concerned that certain material might come in which they don't want to come in via the internet. I was recently talking to a very large international bank, which has just, a riba bank, which has just come to an agreement with a major internet portal. And it turns out that on this portal, people can have access to pornography. And the international bank said, well, we don't want to be involved with you if people are going to, after they've accessed our loan products, can go and look at some pornography. We don't want to be part of that. So the portal set up a firewall to prevent certain material coming in, and so the bank felt comfortable with that and is able to sell its products on that portal. So it would seem that there are solutions which would enable those with Islamic sensitivities to use the internet appropriately. And on the final issue of new balance sheet instruments, I think this is a very, very interesting area, actually. And it's interesting to see right here that we've seen securitization of Islamic mortgages, which will enable an institution like LARIBA to do more business without having to increase its capital, so it can put more volume through the balance sheet. Other areas, such as the use of subordinated instruments, where you tranche off risk. So you might have a fund, and you're saying, well, this group of investors is taking this amount of risk, and it gets a higher return. This group of investors is taking this much risk, they get a lesser return, and so on. And that's a major feature of Western financial markets, and it's not clear to me whether that is possible to be done yet in Islamic financial markets. It's important because it enables you to get to new sources of investors. So that I leave as an open question, and I know people like Iqbal are trying to address those. A final point which I want to make before I conclude, and I want to just step back from what I've been saying about specific challenges. Islamic banks are not focused on profit maximization. And I don't mean that they don't try to make profits, What I say is a business model for an Islamic bank is that the most fundamental function which it has is to provide Islamic banking services to the Muslim Ummah. Right? If an Islamic bank does not make money, but it operates in adherence with the Sharia, it is still an Islamic bank. If it makes a lot of money and it doesn't operate in adherence with the Sharia, it's not an Islamic bank. So the fundamental point of a business model for an Islamic bank is that it operates in accordance with the Sharia. What's the problem there? Is there a problem there? The only potential problem is if that philosophy makes managers and shareholders think that they can get away with lower levels of efficiency and lower levels of return. Because they say, well, we don't actually need, that's not what the most important thing is for us. The most important thing is the Sharia, so we don't need to be as efficient as the river bank down the road. And that's moral hazard. Now, I would suggest to you that there's no necessary reason why that should be the case. You can look at the examples of mutual societies where that isn't the case. And I would also, if I've understood Muslim thinking correctly, then it should be the case that because under Muslim jurisprudence there is no dislinkage between economic utility and ethics, whereas in Western economic theory there is no necessary connection between what is right and what is economically efficient. In Islam, the two are necessarily linked because it is a holistic system. If that is the case, then the surest way to maximize profits is to follow most piously the Sharia. And so necessarily, that conflict should not arise. The fact that Islamic banks, the business model is not profit maximization, should not be a problem for them. So this has been a rather sketchy overview of my presentation. To sum up, if we look at those three areas, I don't see any particular reason why Islamic banks should not be less efficient, should not be as efficient as conventional banks. Banks whose business continues to be based on taking deposits on one side and lending them out on the other side, though, will go the way of the dinosaurs. They will become extinct, with the exception of a few pockets in obscure corners of the world, where they will live on as anachronisms, a bit like the giant turtles in the Galapagos Islands, which are the nearest remnants that we have of the dinosaur age. So that will happen whether you're a conventional bank or an Islamic bank. Successful banks will be those that can retain customer loyalty and current profitability by distributing new financial products which meet customers' needs for the future. And I see no reason why Islamic banks should not be able to do that.